Bottom of your screen, see the tech stocks at the NASDAQ were down the most, almost 1%, as Doug Flynn joins us, certified financial planner, co-founder at Flynn Zito Capital Management. I think, Nvidia, the chip maker, reports its earnings tomorrow night. And this is to me, the stock of the week. It was down today, but because it's been this high-flying stock, there's only, Microsoft and Apple that are worth more in the market among U.S.-based companies than Nvidia. So the question is, can it continue, or are we starting to see the signs that it cannot, and therefore the market rally, especially in tech, cannot? What do you say?
Well, part of the reason why it kind of sold off a little bit today is because it had such a crazy run. It's up 38% year to date. But I always look at it like this: $10,000 invested in Nvidia 5 years ago is worth $185,000.
Wow.
So could that turn into 3.5 million? That's the same math 5 years from now, and I would say that's unlikely. And so if you look at valuations, it's trading at 2 times the value of the tech area, and the tech area is trading at 2 times the valuation of the overall market. So it doesn't surprise me that it fell down a little bit. In fact, actually, it fell below. It's now number 5 because of today. So they're right there with Google and Amazon right there fighting
with
it out.
All the big boys in there. I mean, and again, Nvidia is a chip maker. This is all an artificial intelligence play, is really what it's about, all about AI. Deal today, credit cards, that was a big headline, in that Capital One buying Discover, $35 billion. It's the biggest deal of the year so far, as this Bloomberg headline tells us. What does it mean, especially for regular people, consumers? What do you think?
Yeah, Capital One is in it for the deposits that Discover has. Unlike credit card companies, they don't really have deposits. So this is an interesting deal, and it's a little bit different. The one thing I found really interesting is that Elizabeth Warren already came out and said it should be banned and we shouldn't do it. So that's already on the record.
Right.
But and they're going to face some regulatory hurdles because it is a competitor to Visa, MasterCard, and American Express. And Capital One issues Visa and MasterCards, but they said they're going to keep the Discover going from a competitive standpoint. And I think they want the information that you can get from those people who spend on the credit cards, and they want access to deposits. The interesting thing to me is typically when a company is buying another company, the company that's getting purchased goes up, which the stock did today, about 14%. But also Capital One went up. So the market is liking this deal, even if the regulators at this point don't seem to.
That is interesting. Elizabeth Warren probably has those press releases pre-written on some of these deals and just fills in the companies because she's been very consistent over the years on not wanting to see these big combinations. All right. It is Tuesday, so that means I brought my cards here. It's Tax Tip Tuesday with Doug Flynn. So we're doing this up until tax day. So let me bring up the first screen on Tax Tip Tuesday. We're going to talk about itemized deductions. Take it away, Doug.
Yeah, so right now, when most people file their taxes, they take the standard deduction, and that's up to 90% of all filers take the standard deduction. This goes back to a couple of years ago when they said we're going to make it really easy for everybody to file. They increased the deduction quite a lot, so a lot of people just take it. But if you're in that 10%, and I do think that 10% could be a larger percent that itemize, because just as a quick example, those deductions on the standard are about $13,850 as a single person. It's about $27,700 if you're married. But if you itemize and you can get more deductions by detailing it, you could take the itemized deduction. So, for example, new homeowners, people that just took out a $400,000 mortgage at maybe 7% as an example lately, the first year you're at about $28,000 of interest. Now, that's only in the last couple of years. So a lot of people that were taking the standard deduction a couple of years ago might very well be looking at taking the itemized deductions, because it's not only mortgage interest, but it's mortgage insurance premiums, it's state and local taxes up to the cap, medical, charity, all that you bundle together. And so the quick tip is, if that math equals more than the standard deduction you would take, take a look, run both, run the standard versus the itemized, see if you qualify. Even if you haven't in the past, you very well might now, especially if you're in that situation with being a homeowner of late.
I think that's a really good point that you make, even if you have it in the past, because people, they get so used to doing things the same every year. You know what? Just take a look, talk to somebody like you, and maybe it makes sense. And if it does, give it a try. Thank you, Doug. Tax Tip Tuesday with Doug Flynn. We'll see you tomorrow with more business news.